Recording started.
Okay. Good morning. We are going to finish up Chapter 6 today. So what we're going to be doing is we're going to start with just a couple announcements, a reminder about what to do. We have Attendance Quiz 14. That will be available Wednesday today by 5 p.m. Chapter 6 homework, do allow yourself plenty of time to work on this. And then the video quiz 15 over Chapter 7 is available in my accounting lab, and that's due Sunday. Yesterday I put up 3 links to 3 homework problems that were not covered in class. I didn't want to go at breakneck speed, so I picked ones that you may or may not need a video how-to on, and I recorded each of those. I recorded them separately, and those videos range from 3 to 5 minutes. So if you need those, I sent out an announcement yesterday on that. Okay, just a reminder, Brian's still here, but Haley is moderating the 7:45 class. She's also doing tutoring. I will be sending out a tutor sign-up link on probably Thursday evenings or Friday, somewhere in that, for the following week. So we had the first tutoring yesterday. It went well, and she's got tutoring today and tomorrow. And that sign-up, you have to sign up at least a day in advance so we can plan for a room that's big enough, etc. So watch your email for that. We can help you if you need tutoring. Okay, so we're going to start with this problem. Now this is a review of what we did on Monday, but I'm going to give you a minute to write down the data here, and then we're going to walk through this. But write down the data, so I'm going to go quiet for a minute, write down the data, and then we're going to walk through this. But do give it a try on your own, because you'll learn better if you try it on your own. Even if you're not right, we can work through it.
I was in bed watching it on Monday.
Okay. Okay. I'm looking over people's shoulders now to see if they have answers. And I don't know what the answer is, so but we'll find. We're going to find it. Yeah. You think it's D? Okay. Got here. Hi, Candace. Okay, that's fine.
I got 9.
That's what she got too. Okay, so we have 2 for D. No calculator, huh? Do it by hand, it's good for you. Good morning.
Good morning.
Wave to people. Okay. Now, hopefully you've written down the data at least, but notice what I wrote down at the bottom. I wrote FIFO means oldest one sold, newest one still in ending inventory. If I approach any problem, I'm writing down what FIFO or LIFO means, because it's very easy to get confused. So FIFO means oldest one sold, newest one still in ending inventory. So I'm looking for ending inventory using FIFO. Okay? So I've got newest one still in ending inventory. So it tells me my ending inventory is 65 units. Okay, so we're going to start with the newest ones, and the newest ones purchased. Okay, on December 31st, that's not a purchase. It's just telling us that we have 65 units in ending inventory. So if my newest ones are still in ending inventory, I have 65 units. I'm going to start with that purchase on October 17th because those are my newest units. So what I'm going to do here is I'm going to say, okay, so on the 17th, I'm purchasing 25 units at $15 per unit. I have 65 units in ending inventory, but I'm going to use all 25 of those. Okay? So I'm going to take the 25 units and say those units are in my ending inventory. I have 65 units in ending inventory. I'm going to subtract the 25 units that I just calculated. There's 40 left. Okay? So I'm taking 25 units at $15. But now I need to find 40 more units. So then I'm going to go up to the next one. So now I need to use those 20 units at $14 per unit because I've got 65 units. So now I've got 25 left. Okay, I have okay, 45 units. Where's my math here? What? Yeah, that's what I meant. That's what I meant, not 25. Okay. Okay. So then, okay, so let's correct this. Okay. So we'll just do this. Hold that, please.
Do you need to?
I'm going to correct this real quick. Oh, I don't need it. I don't want to. I want you to hold it.
Hello, everyone.
No.
No, probably not.
No, it's me. I want to talk. No, it's okay. Okay. Well, let me just go to this one. Let's just go there. Do the magic of up. Okay.
No.
It'll be fine. We'll get there. Okay. So we'll get that. Sorry about that typo. Okay. So what we've got then is we're using the 25 units from October 17th, 20 units from August 15th, and 20 units from May 20th. So when we get that, we get $915 as the total value of our ending inventory. Okay? So when we did this, we used FIFO, so we are starting from the most recent and working our way back until we find the 65 units. Okay. Okay. Good on that? Let me see. Okay. Okay, another homework problem. Okay, so on 619A, we have a bunch of data given to us. We have the beginning balance June 1st. That's our beginning balance of inventory. We purchased inventory on June 2nd for 4 units at $69. We sold inventory June 7th for 7 units, and we sold inventory June 13th for 5 units. So on requirement 1, we need to calculate cost of goods sold and ending inventory, both FIFO and LIFO, and then we have to do an income statement for requirement 2. So what we're going to start with okay, first thing, before we answer anything, we need to calculate how many units were sold. Okay, because we have a beginning balance, we have purchases, and then we have 2 sales. So this one's actually pretty easy. Okay, we just add the 7 and the 5 together. So we sold 12. So this information is generic in that we use it no matter what method we're using. Next question is how many units are there in ending inventory? And this again is a generic question because it doesn't matter if we're using LIFO or FIFO. We're looking for the number of units. It doesn't tell us the number of units. It tells us that we started with 14, we purchased 4, and then we sold 12. We just calculated that. So to calculate our ending inventory, we start with that beginning inventory plus our purchased minus our sold. So we have ending inventory of 6. Okay, so those are basic calculations we need to have regardless of what method we're using. So when we approach a problem, it's really good to get all your numbers together and know, well, gee, I sold 12, I have 6 in ending inventory. My total available for sale was 18. That's the beginning inventory plus the purchase. So notice at this point, I haven't started the problem yet in terms of specifics. I've just satisfied myself with how many I sold and what's left in ending inventory. Okay, so we've got 6 in ending inventory, sold 12. So let's go on, and we're going to do FIFO first. Okay, so FIFO at the bottom means oldest ones sold, newest ones still in ending inventory. Okay, so we're going to answer cost of goods sold. We sold 12 units. We said we sold 12 units. Our oldest ones are sold. Under FIFO, oldest ones are sold first. So our oldest units are those beginning 14 units. There's $42 each. So 12 units at $42 each gives us cost of goods sold of $504. Okay, now that's cost of goods sold. So next we go to ending inventory. Now ending inventory is our newest units. So ending inventory, the newest units purchased, so we have the purchase June 2nd of 4 units. So we have 4 units at $69. But ending inventory is a total of 6 units, so we have to take 2 from that beginning balance. So we've got 4 units at $69 and 2 at $42. So we have a total value of ending inventory of $360. Okay, so that's the answer for requirement 1A, FIFO. What's FIFO, cost of goods sold, and FIFO ending inventory. Now we move on to part 2. Okay, part 2, LIFO. First thing, LIFO means newest ones sold, oldest ones still in ending inventory. Okay, so newest ones sold under LIFO, oldest ones still in ending inventory. Our basic rule. So what we're going to do for LIFO, newest units sold. So we're selling 4 from June 2nd. So we're using all 4 of the June 2nd at 69, and then the remaining 8, because we sold a total of 12. So the remaining 8 comes from the beginning balance of with $42 each. So we have 4 at 69, 8 at 42, gives us 612 as our cost of goods sold under LIFO. Okay, so cost of goods sold under LIFO. Now we move on to ending inventory. Ending inventory under LIFO, the oldest units remain. We get all 6 from June 1st because we had 14 from June 1st and we have 6 in ending inventory. So 6 at $42 gives us $252 for our value of our ending inventory. Okay. So that's LIFO. So now we move on to requirement 2. Requirement 2 says they use the FIFO method. So the first numbers that we had, the cost of goods sold and the ending inventory, those are what we're going to be using here. We prepare their income statement for the month ended June 30th, reporting gross profit, operating expenses for $340, and income tax rates 40%. So, first thing on an income statement, very first line after you do the title and everything is going to be your sales revenue. So your sales revenue is the number you sold times the selling price. We see here that we have a total of 12 units sold. They had a selling price of $111 each, so our total sales were $1,332. Okay, so this is FIFO from earlier, so we don't need to write this down. I just wanted to point out to you that when we did FIFO earlier, we had cost of goods sold of 504. So I'm trying to show you where the numbers are coming from. This last screen, we just calculated sales revenue was 1,332. Earlier, a couple slides back, we had cost of goods sold of 504. So now we're going to build our income statement. So income statement, just a refresher, income statement starts with the name of the company. The second item down is the name of the statement, and then the third item down is the date line. An income statement is always for a period of time. It tells us that we're doing an income statement for this month that ended June 30th. Okay. Okay, so first line, sales revenue. Is the 1,332. Cost of goods sold 504. Okay, so those two numbers that we just went over. Then we get gross profit. Gross profit is our sales revenue less our cost of goods sold. Gross profit is also known as gross margin. Our next line down is going to be those operating expenses that they gave us. So they gave us operating expenses of $340. And then we're going to get a subtotal, and our subtotal is income before income tax. So we've taken gross profit or gross margin, subtracted operating expenses of $340, given us income before income taxes of $488. Now, they gave us a tax rate, so what we need to do is calculate our income tax. Our income tax will be whatever percentage they gave us times the income before income tax. So this next line, 488 times the 40% tax rate they gave us, gives us income tax of $195. And then finally, we end with net income, which is our income before income tax minus our income tax expense. So we have net income of $293. Okay, this one's not bad. You just have to make it through FIFO and LIFO and then go back and use your FIFO numbers. So that's the income statement. That finishes up exercise 619A. Okay, so now we have a question. Weighted average cost per unit is calculated as the cost of goods sold divided by the number of units actually sold. I'm going to go up here. Let me see. What do you think? Okay. Okay. True? Okay. What do you think? True? What do you think? True? Okay. Did you read it now? What do you think? True? Okay. What do you think? True? True? Okay, what do you think? True? Okay, I'm going to stop right here. What's the polling like online? 17 true, 3 false. I'm going to go with John here. He says false. Okay, good job, John. Okay, so this is false, and the reason it's false is because of the word sold. When we calculate a weighted average cost, we're using the number of units purchased or produced, depending if we're buying our inventory or making it. But we want to use the number of units purchased or produced. So this is a good point to know that when you do an average cost is so easy to calculate as long as you use the right number of units. And the right number of units is the number of units purchased or produced. So this is an example where it's just one word makes this statement false. Okay, next. Exercise 612. Okay, 612 is kind of a fun one. We're now switching over to what happens if we mess up inventory. Inventory errors impact 2 years typically. So we'll go through that. But this is 1 year only, so we're going to start looking at 1 year. Now when you see an inventory problem where it's talking about an inventory error, the first thing I like to do is I like to think about how is my income calculated. Well, my income is calculated where I have year 1 in that table. Income's calculated as sales minus cost of goods sold equals gross profit. And then if I were to go further, I would subtract operating expenses and get income, just like that income statement we just did. So I'm putting the names under year 1 just to remind myself to visually see how income is calculated. Then cost of goods sold then, how is it calculated? Well, it's calculated by taking beginning inventory plus purchases minus ending inventory. That's how we get cost of goods sold. And remember, I said I'm very visual. I need to write down clues to tell me, to help guide me through answering these questions. I don't memorize all these different circumstances in my mind. I don't memorize, boy, if I overstate sales, what happens? I reason my way through it. So I have what I've just said here, the year 1 with the little box off to the side. That's what I'm going to use to reason my way through this question. And we're going to do a couple of these inventory error questions so we can see this kind of thing. Okay, so first question says, well, it tells us, first of all, ending inventory was overstated by 13 million. That's in the problem. So they overstated ending inventory. Ending inventory was too high by 13 million. So what's the correct amount for net sales? So I'm going to start over here. I'm going to start right here. Hello. Okay. So we're going to start with net sales. So looking at my little diagram, does ending inventory impact sales at all? No. So the correct amount for sales would be what, the 2,500,000, right? So you got it right. Great. Okay. So see, we look at the diagram. Ending inventory does not impact sales at all. Okay? So the correct amount for net sales, 2,500,000. It's unchanged because there is no impact of ending inventory on net sales. Okay, so next one over is now ending inventory. Okay, so ending inventory, it's asking us what the correct amount is for ending inventory. how would you calculate that, ending inventory? This one's actually pretty easy too, right? It tells us we're overstated by 13 million. So what do you do? Right, so you would subtract the 13 million from the 480, right? Yeah, so we take the 480 minus 13. Okay, so far this is pretty easy. I think I'm going to go over here. Hello.
Hello.
Okay, so next one down. Now you get a more challenging one. Yay. Okay. Okay, so next one down. It's asking us for the impact of inventory. Ending inventory is 13 million too high. So the impact on cost of goods sold. So we see over there that cost of goods sold is calculated as beginning inventory plus purchases minus ending inventory. So if ending inventory is 13 million too big, what's that going to make? It's going to make cost of goods sold too high or too low. Right, it'll make it too low. So to adjust it, we need to add it back. Yes. Okay, exactly. So you got it right. So you see how looking at that diagram will help you. You didn't know that ahead of time, right? But you could reason it through if you had it right beside you. Yes, just a minute. Let me come down there. Okay, let's go back. Okay, ending inventory is 13 million too high. And to get cost of goods sold, we're taking beginning inventory plus purchasing and subtracting out ending inventory. So we subtracted out too much, so it made cost of goods sold too little. So beginning inventory, let's say beginning inventory, can I do any easy numbers in my head? I'm going to get in trouble here. But let's say beginning inventory is $40 and purchases are 10. Okay, so we have $50 then, 40 plus 10, and then ending inventory, let's say, was 23 instead of 10. So if we took 50 minus 23, we would get 27, right? 50 minus 23. Are you following along math? Because this is challenging. Okay, so we got 27, right? So now we're saying ending inventory shouldn't have been 23, it should have only been 10. Okay. So then my cost of goods sold should have been 40. Okay. Do you see where we're going with that? Okay, so and sometimes that's a really good strategy too, you know how we just put some fake numbers on there, and you can see what you had to do to get the right one. Okay, so thanks for the question. Okay, so we would add that back. So now we're going on to the last one. I think I'll stop here. Okay, so this last one, gross profit. Okay, so this one you've got to, so we know ending inventory too high. So the impact on gross profit, so we have to do two calculations. So we said if ending inventory was too high, cost of goods sold needed to be up. So cost of goods sold should have been higher. So cost of goods sold was too low. If cost of goods sold was too low, gross profit, if we're subtracting out too little, then gross profits go too high. So let's see what I have here. We would need to subtract the new cost of goods sold. So the adjustment here, basically how you could answer this question is you could go back. We know that the new cost of goods sold was 1,173, right? Because we just calculated that in C. So we can calculate the new gross profit because we know gross profit is sales minus cost of goods sold equals gross profit. The problem is asking us what's the new gross profit. So if we know from C that we had cost of goods sold of 1,173, we subtract that from net sales of 2,500 and we get 1,327, and then we compare that and we see gross profit, it wasn't asking if it went up or down, it was asking for the new amount. So I was asking you for a question it wasn't asking, but just walking our way through it. So on those, the very best thing you can do is have that little chart there to be able to fill out some numbers as you need them. Okay? Okay, and we're going to do another one today that has 2 years, so you can see the impact of errors over 2 years. A lot of times you'll read an article, you'll hear something in the news that a company is correcting their inventory, and inventory corrections can be huge sways. They have big impacts on stock prices, so it is a big deal if a company makes an error in inventory. Okay, so here's a true-false question. Overstating ending inventory in the current period will overstate the following year's net income. True or false? Okay, so here's a hint as you're figuring this out. How would I solve this question? Again, I do not memorize the impact of these things. And I would say if I read this, overstating ending inventory in the current period will overstate the following year's net income, I don't know off the top of my head. I don't waste my storage in my brain on memorizing these. What I do though is I say, okay, I know that year 1, my beginning inventory plus purchases minus ending inventory equals cost of goods sold. So then year 2, my ending inventory from year 1 becomes my beginning inventory in year 2. And we're calculating the expense. So then we say, okay, so overstating ending inventory in the current period will overstate the following year's net income. Now the little chart I put up there is for cost of goods sold, which is the expense. So we have to think further beyond this. But I wanted to illustrate with this to remember ending inventory in one period is the beginning inventory for next period. Okay? What do you think? You think it's false? I had some trues over here. Okay, what about you? False? True? False? False? Okay. What do you think? False? True? False? Okay, so we have a wide variety of answers. What do you have? Yeah. 12 false, 8 trues. Okay. And it is false. Okay. Overstating ending inventory in the current period will understate the following year's net income. So we have to look at our impact on cost of goods sold. If our ending inventory in the current period is too high, then our beginning inventory in year 2 is too high. So we're going to have too high of beginning inventory in year 2. So I'm going to start with an inflated year 2, so that means my cost of goods sold is going to be too high. The question is about net income. Expense reduces net income, so this is false. I think I have another one. Okay, true or false? An error in ending inventory creates errors for 3 accounting periods, meaning like 3 years or 3 months, 3 quarters, however we're doing this. False? Okay. You're going to say true? Okay. False? Okay. What do you think? False? 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 Okay. It is false. It impacts 2 periods. It impacts the period that you make the error and the following period, and then it'll fix itself. Okay? So over 2 years, if you add everything up, you'll have the same amount. But it can have an inventory error is a big deal. It will wash out after 2 years, though, or after 2 periods. Okay. And this is an error in ending inventory. Okay. So it impacts the ending inventory for one period and the beginning inventory for the next. Okay. So now, talking about, we said it impacts 2 years, right? So an error in ending inventory for the year ended December 31st, 2011. So an error for 2011 in ending inventory, what does that do? Does it impact? A says automatically creates errors in cost of goods sold in 2001 and 2002. B has effect on the 2011, has no effect on 2011, but creates an error in 2012. C automatically creates errors in ending inventory in 2011 and 2012. Or D affects only 2011 financial statements. Okay, this one shouldn't be too bad at this point. A. A. Alyssa? Okay, okay. A or C. Yeah, this is, well, yeah, it's A or C. Yeah, okay. So we can eliminate, so that's a good point. We can eliminate B and D right off the bat, right? Because we know this impacts 2 periods. So if we're just looking to maximize our chance of getting this right, we're going to eliminate B and D. Okay, right off the bat. So now we know it's A or C. Now A says creates error in cost of goods sold on both statements. Okay, so that's, and then let's look at C. Automatically creates errors in ending inventory in 2011. That's right. Does it create error in ending inventory in 2012? Beginning inventory in 2012, right? Yeah. So that's why we can eliminate C. So where we get to on this one is A. And that difference, it was very subtle again. It only impacts the ending inventory for 2011, the beginning inventory for 2012. That's why C is not right. Okay. So the ending inventory relates to the beginning inventory from the next year. Yes. It creates errors in cost of goods sold in 2011 and 2012. Okay? Cost of goods sold wrong in 2011, 2012. Okay, this one is really fun because it's 2 years. So we're on to these error corrections, and it tells us that they had a $4.8 million cost of inventory at the last year was understated by $1.4 million. So we have an error in ending inventory. They started with, they had $4.8 million, and that was understated. So it should have been $1.4 million more. Now, so the first question was last year's reported gross profit of $3.7 million, overstated, understated, or correct? And what was the correct amount of gross profit last year? So what I'm going to do right now is I'm going to pause for a minute. Really, this would be very useful to write this down. Okay, year 1, I've got the formula for calculating operating income, and below there, beginning inventory plus purchases minus ending inventory equals cost of goods sold. That's the formula for how to calculate cost of goods sold. So I'm going to pause for a minute, let you write those down, because we're going to be using lots of arrows to point out, to figure out this problem. Still writing down if you're watching this later, wondering why it's a big pause. Okay, so let's assume we've got this written down. And again, so much of this is writing it down and taking it step by step, because I can't look at these and just know off the top of my head the impact. And maybe you get to that point if you work with it every single day, but For me, I'm very visual. I have to have it written down. Sometimes I put numbers on these things, make up numbers, and then see the impact that way. Okay, so first question. Okay, ending inventory. Okay, it was, they said it was 4.8 million. It was understated by 1.4 million. So that was too low. Okay. So ending inventory is too low. If ending inventory is too low, that means that cost of goods sold is too high, right? And we know the amount of the difference is 1.4 million. So ending inventory is too low. We would need to add 1.4 million to it. Cost of goods sold is too high, so we would need to subtract 1.4 million from it. So we're just going to go step by step and trace this impact back. So we know ending inventory is too low. If ending inventory, if we're subtracting out a number that's too little, that means cost of goods sold is going to be too high. Next, so then that means that cost of goods sold on our income statement is too high. Okay? So we're saying sales minus whatever is 1.4 too high. So cost of goods sold in our income statement is too high. If cost of goods sold is too high, then that means our gross margin or our gross profit is too low. And if gross margin is too low, operating income or net income will also be too low. Okay, so and we know the difference is 1.4 million. So we could take 1.4 million and adjust each of those numbers to get the correct number. So back here, we said that operating income is too low, right? So that's where we are. So now, going back to the question then, operating income was, or gross profit was understated. So the correct gross profit should be 3.7 plus 1.4 to make it higher. If it's understated, we need to add that difference to make it higher. Yes, gross margin is the same as gross profit. It is. I'm correcting Brian. So the two terms are interchangeable. So, sorry to override, but I wanted to get that corrected. Yeah, you probably. Okay, so gross profit and gross margin are interchangeable. Sorry, Brian, I just had to correct. Okay. So Brian has his own unique system. Okay. Okay. So we're good on part one. So now, part two says, that was last year's. Part two says, is this year's profit of 4.6 million overstated, understated, or correct, and what's the correct amount? So, okay, so again, we're starting with our basic setup that we had, and year one was past year, year two is this year. So if ending inventory from last year was too low, that means beginning inventory this year is too low as well. Okay? So if beginning inventory this year is too low, that's going to make cost of goods sold too low. So we're starting out with too little. We're adding purchases, subtracting ending inventory. That means that cost of goods sold is going to be too low. And you are right. Gross profit and gross margin are different from operating income and net income. Yeah. Okay. So cost of goods sold is too low. So then if I go up to my income statement, I've got cost of goods sold too low. If cost of goods sold is too low, gross margin or gross profit is too high. If gross margin is too high, operating income is also too high. And if it's too high, we need to take that amount of adjustment and subtract it to get our answer. Okay, so we've said gross margin is too high, so then to calculate what it should be, our gross profit is overstated or too high. Correct gross profit is the 4.6 million minus the 1.4 million adjustment. I cannot emphasize enough having the little structure. I'm going to come back to this, but having the basic statements there, of course, on your reference sheet would be really great to have, because then you can reason your way through any of these type of questions. Okay. Okay, now switching gears. Here's one more thing. Back to the reading of the video. Which of the following is not used to determine net purchases? We've been talking about beginning inventory and ending inventory, and then we forget that in there we have to add purchases. So what's net purchases? What is not part of net purchases? Freight out, freight in, purchase returns, or purchase discounts? And we, yeah. Okay, so I'll be back. Okay. I do. Yeah. Yeah. Okay. Okay, that's fine. Do you know what this one would be? Okay, you have a D. Okay. Do you know what this one would be? Not sure? Okay, I think I'm going to go with you. Okay, so on this one, the correct answer is A. Okay, yay. And that's all right if you didn't know it. We'll talk about now what all these items are. So net purchases, the word net means that we've taken purchases and added or subtracted some other things. Just like when we said we had net sales, we could subtract things from it. Net purchases starts with purchases, and we're going to subtract purchase. So we'll start at the bottom of the list and work our way up. We start with purchases, we subtract purchase discounts. These are all good terms to know, even though they're not the answer for this question. Purchase discounts is the discount or the reduction we get for paying our bill within the discount period. When we talked about receivables, we talked about terms of 210 net 30. You know, those discounts that we get for paying within the discount period, that's a purchase discount. We can get purchase discounts on things we make. So purchase discounts reduce purchases to get net purchases. So purchase discounts are very specific, relate to paying within the discount period. Now, item C is not the answer. Purchase returns are we purchase something, we send it back. And that seems pretty evident that we would reduce purchases by the amount we returned. B is freight in. That is the freight that it costs to get our merchandise to us. Now, this is inventory. Purchases, we're talking about purchasing inventory that we're going to sell. So if we're in business and our business is selling T-shirts, we buy those T-shirts, they charge us freight to get them to us, we pay the freight. That is part of the cost of our purchases. So freight in is part of purchases. So freight in is part of net purchases, and we would add that to purchases. Purchase returns and purchase discounts are subtracted. So then we finally get up to the wrong answer. Freight out there's not a specific term freight out, but if we visualize what freight out is, that's paying for freight to ship it to our customers. That's not part of purchases at all. That occurs after we've purchased. That doesn't have anything to do with the purchase. That's part of sales, so that's a different question. So net purchases will be purchases plus freight in, plus any taxes we pay or import duties or that kind of thing. Subtract purchase returns, subtract purchase discounts to get net purchases. Okay, so now another one of those smaller type concepts we haven't talked about. Company A has inventory out on consignment and held for sale by Company B. Which company will include the inventory in its own inventory? So which company is going to include it on their balance sheet? Company A, Company B, either A or B, or you can't tell. So consignment. So Company A has inventory out on consignment, and Company B has it in their store. So B is going to be like one of those consignment or resale shops. So B has the inventory in their store. Which company reports that consignment inventory on their balance sheet? What do you think? Company B? Okay. Okay. What do you think? B? 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 You're on with B, okay. Oh, I'm back to you again. What do you think? B? What about you? You guessed you'll go with B. Okay. Let me. Georgie, what do you think? A or B? I'll tell you, it's either A or B. I'll give you that much. B. Okay. Okay, I'm back here. Yes. Okay. B. B. A. A. Oh, let me go in here. Okay, Brian, what do you guys have, or Haley? We have 6 A's and 14 B's. Okay, well, good job over here. The answer is A. Okay, so let's talk about why that is. Company A owns the inventory. Company B is simply offering it for sale. Company B doesn't pay for the inventory. When you have inventory out on consignment, you own it, it goes, so Company A has the inventory. They have legal title to it. When you have something on consignment, the person that originally owns it continues to own it until it's sold, so it's on the original balance sheet. Company B doesn't have any inventory. They haven't paid for it. They can't put it on their income statement or their balance sheet because they haven't paid anything for it. They don't have legal title for it. And there's been a lot of this is an area where companies can get into illegal, fraudulent reporting where they'll say, oh, we have this inventory that's on consignment, we haven't paid for it, but let's go ahead and put it on our balance sheet and tell the auditors it's ours. So we have to really be careful that we only report stuff on our balance sheet that we actually own. Okay, so if you have goods on consignment, the company that holds the title, the company that owns the inventory has it. It's not possession is 9 tenths the law. Possession doesn't have anything to do with this. It's who owns it. Okay, now we wrote these down last time. Okay, I just wanted to put another plug in for them. Okay, just to make sure you know these things, because you're going to see these basic structure over and over and over in this chapter, and I'm not going to dwell on this because we had it all on Monday. But then we're back to that problem in the beginning, but now I've changed it. So same set of data that we started class with. Now we're going to calculate ending inventory using LIFO. So everything's the same other than we're using LIFO. So we're going to take a minute or two, and I'm going to go around and get people's take on this. Okay, so you've got the same answer. Here I was thinking this would be challenging. Wait, you okay on this?
Yeah.
Okay. Wow. See? Getting a lot of C's. What do you think? Oh, you're not done yet. Okay. See you today. Nice. Now I know your name and everything, so that's great. Okay. Just another plug. Come meet me in my office because it is so nice to know people like I know Blake and I know you now. So earn your do-over, even if you don't need it. Okay. So, okay, what do you have online? What kind of polling? 2 A's, 2 B's, and 9 C's? I'm going to keep asking. What do you have? C? Okay, okay. I've asked over here. I haven't been over here because I don't want to walk in front of the camera. See, now I don't want to walk in front of the camera, so now I'm coming back this way. See? Okay. Lots of C. Okay, so I'm getting lots of C's. So so how we do this, if you haven't done it, is we start, the answer is C, to put you out of suspense. Start with the oldest ones in ending inventory, so we're going to start with that beginning inventory. We have 30 units. So of our 65 units in ending inventory, we use 30 from beginning inventory. We have 35 left, so we have to use all 15 from February 25th. And then that extends down to 20 units from May 20th. So what we end up with, when this is all said and done, okay, we end up with using 30 units from January 1st at $10 each, 15 from February 25th, and then 20 from May 20th. So whether you use FIFO or LIFO determines which end you start at, okay? So they work the same way, but it's so important for me to write down on the bottom, but I'm learning other people don't have to write it down. But for me, I write down everything and then I can rely on it later. Okay. I'll wait just another minute till I see pencils go up. Okay, and you know what this means. We're out a little bit early. So make sure you do the homework this weekend. Make sure you do the attendance quiz. And remember that there were a couple homework problems I didn't want to cram in, and I put those out online if you want them. So have a nice weekend, and I'll see you Monday.